The Subcommittee on Housing and Insurance will come to order. Without objection, the Chair is authorized to declare a recess of the committee at any time. This hearing is entitled "The Characteristics and Challenges of Today's Homebuyers." Without objection, all members will have 5 legislative days within which to submit extraneous materials to the Chairman for inclusion in the record. So I now recognize myself for 5 minutes to give an opening statement. Today we bring together a panel of our nation's housing experts to delve into housing challenges in purchase markets across the country. Namely, we have asked our witnesses the question, who is buying housing today and how are they paying for it? These may seem like simple questions, but underlying them are more complicated factors that have been driving unaffordability for millions of American families. Let's break this down. The 30-year fixed mortgage has increased over 100%, double since 2020, doubling the average monthly payment. That alone is twice the amount of pain for everyone wanting to buy a home. But wait, there's more. Because of the lack of housing inventory, the median home price has gone up too, by 27% just since 2020. How many of us have engaged in America's new pastime of looking up homes for sale on an app like Zillow or similar? You won't find nearly as many homes available as you did just a couple of years ago, and some have shockingly high price tags. These high prices are great for the current owners, but they're difficult for anyone looking to move anytime in the near future, as their equity is now worth more. There is extremely disheartening for anyone who's in the market for a new home, including repeat and first-time home buyers. Many families are putting their dream of owning a home back on the shelf, needing to save more for that down payment, and finding it harder to do so because everything else is expensive too. The cost of groceries, the cost of gas, cost of health care, cost of a family vacation, you name it, you are probably paying much more to live in the United States than you were in 2020. Inflation is a tax paid by everyone, and it's unfortunately part of a vicious circle that puts even more pressure on the housing market as interest rates go up and stay up, construction costs go up and stay up, and frankly, insurance costs for the home go up and stay up. Many would say that we are living in a, quote, new normal, where higher costs are here to stay. If so, this could have serious implications for economic mobility and prosperity. Owning a home should not be only for the well-off. It is the hallmark of a thriving middle class and an essential part of the American dream. I think all of us on both sides of the aisle will agree that the shrinking pool of eligible homeowners is a cause for concern. The solution is not simply to increase federal spending on housing, however, which will only drive inflation and increase demand for housing, adding more price pressure. Our economists here today know very well that inflation is what has gotten us into this mess in the first place. I also have a hard time agreeing that more government interference in single-family housing is the answer, when over 80% of the market is federally backed and the Federal Reserve holds a shocking $2.4 trillion in mortgage-backed securities. President Biden recently called for a tax credit, a new tax credit of $5,000 a year for 2 years for first-time home buyers and $10,000 for some who agree to sell their homes, among other costly proposals. These ideas are not enough to counter the high cost for home buyers, and they're too much for taxpayers who would be forced to subsidize another $260 billion in new spending on federal housing programs. That makes me think that they're not really serious proposals. With the demand for housing we see today and the lack of inventory, the answer is not to increase demand further with artificial stimulus. It is to work together to increase the supply. That will take the will of policymakers at all levels of government, as well as the private sector responding to market forces. I hope today's hearing will provide a forum to discuss credible solutions to our housing challenges, as well as what is driving them. So I look forward to all of our testimony from our witnesses, and I would just share a story. Recently in Ohio, Western Ohio, we had a mobile home park with about 1,700 homes in it. The average rent was less than $1,000 a month, some as low as $500 a month. And there's no ready supply where these people are going to find homes that are in that affordability range. So when you have a massive increase in demand, especially in a localized area, you can't immediately respond to the supply. We have challenges like that all over our country, and I look forward to the discussion. Thank you, and I yield back the balance of my time. The chair now recognizes the ranking member of the Subcommittee on Housing and Insurance, the gentleman from Missouri, Mr. Emmanuel Cleaver, for 4 minutes for an opening statement.
Thank you, Mr. Chairman. Mr. Chairman, thank you also for holding this hearing on the characteristics and challenges of today's home buyers, which has been described as an effort to better understand the current profile of the single-family housing market. I want to thank the witnesses for presenting data on an ongoing basis, including today, about the housing market and challenges facing borrowers. I also appreciate that all your organizations have identified, worked on, and endorsed legislation that would help solve the affordable and fair housing crisis and bring the American dream of home ownership within the reach for millions of Americans. It is an election year, and the American public needs this committee to immediately mark up these critically important proposals, which becomes increasingly challenging the closer we get to November. I'm particularly eager for our subcommittee to act on rural housing legislation that I have joined my friend and colleague, Congressman Nikitra, in introducing. The legislation would improve USDA-supported housing in rural America. Every community, whether in urban, suburban, or rural America, is united in the desire to have a real opportunity to live in a decent, affordable house. Having reasonable access to shelter is a core human need of our constituents, along with food and water. It's not a luxury. Americans in every community are also united in the desire to own a piece of the American land and be able to pass this generational wealth down to their children. It's an American dream, has become an American fantasy for way too many families. Several factors influence the price of housing. At the core of the housing affordability crisis is a crisis of supply and demand that is driving costs. The United States has a shortfall of 6.5 million single-family homes due to underbuilding. I welcome the committee moving to a bipartisan, bicameral, yes, My Backyard Act to make up, among other proposals. The Joint Center on Housing Studies of Harvard University found that in 2022, the median sale price for a single-family home in the U.S. was 5.6 times higher than the median household income, higher than at any point on record dating back to the early 1970s. Many would-be first-time home buyers, particularly young families, are eager and sometimes furious over the prospects of trying to get a home. In 2019, the racial homeownership gap was the widest it has been since the census began recording rates. And I think my time is running out.
The chair now recognizes the ranking member of the full committee for 1 minute for an opening statement.
Thank you very much. The American dream of home ownership symbolizes financial security, economic mobility, and a sense of belonging. But for too many in today's market, this is a dream deferred, a dream reserved only for the wealthy. Our constituents are confronting aging homes at historically high prices, rising interest rates and insurance costs, hidden fees from industry, and ongoing discrimination. People are working more jobs, longer hours, and still can't seem to make it. These are not new issues, but they are made much worse as the affordable housing crisis grows, something that committee Republicans have shown absolutely no interest in solving. So I welcome today's witnesses and our discussion, but Congress must come together to create real pathways to affordable housing and home ownership for all. I yield back.
Thank the ranking member. Today we welcome the testimony of Michael Fratantoni, Fratantoni, my apologies. He is the Senior Vice President of the Research and Industry Technology at Mortgage Bankers Association. Jessica Lautz, Dr. Lautz is the Deputy Chief Economist and Vice President of Research at the National Association of Realtors. And Nikitra Bailey. Ms. Bailey is the Executive Vice President at the National Fair Housing Alliance. You'll be recognized each for 5 minutes to give an oral presentation of your testimony. Without objection, your written statements will be made part of the record. Dr. Fratantoni, you are now recognized for 5 minutes for your oral remarks.
Chairman Davidson, Ranking Member Cleaver, and members of the subcommittee, thank you for the opportunity to testify today. My name is Mike Fratantoni. I'm MBA's Chief Economist and Senior Vice President of Research and Industry Technology. My testimony today reviews current trends in the mortgage market, focusing on the buyers, products, sources of financing, and obstacles that home buyers and lenders face. In my written statement, I also examine some of the current trends in the rental housing market, including that for single-family rentals. How large is the single-family residential mortgage market? $45 trillion in real estate is owned by households, with $32 trillion in home equity and $13 trillion in mortgage debt outstanding. In 2021, lenders originated a record amount, almost $4.5 trillion in mortgages. To contrast with that, MBA is forecasting about $2 trillion in originations for 2024, up from $1.6 trillion in 2023. These mortgages fund both the purchase of homes and the refinancing of existing loans, supporting a U.S. homeownership rate that in recent years has hovered around 65%. Regrettably, there remains a wide homeownership gap across different racial and ethnic groups. Of the $13 trillion in mortgage debt outstanding, roughly $9 trillion is securitized through Ginnie Mae and the housing government-sponsored enterprises Fannie Mae and Freddie Mac. Most of the remaining $4 trillion of mortgage debt is held on bank portfolios as whole loans, with some held by other types of investors. Before the great financial crisis, as much as half of securitized mortgage volume was private label. The PLS sector is much smaller in today's market, comprising about $80 billion or so of the $1.6 trillion originations in 2023. About $30 billion of this volume in 2023 was non-qualified mortgages, known as non-QM, with some more flexible underwriting standards intended for self-employed borrowers or others with more complex financial or employment patterns. Typically, more than 80% of mortgages used to purchase a home are 30-year fixed-rate mortgages, while many refinance borrowers opt for shorter-term 10, 15, or 20-year mortgages. Most of the remaining loans, which are a small percentage of overall volume, are hybrid adjustable rate mortgages with initial fixed rate periods of 5, 7, or 10 years, and then more frequent rate adjustments. 2022 HMDA data show us that 70% of home buyers who used mortgage financing took out conventional conforming loans securitized through the GSEs. 14% used FHA loans, 9% VA, 1% RHS, and 6% use conventional jumbo loans. MBA's mortgage applications data typically show that about 90% of applications are for buyers who tend to occupy their homes as primary residences, while the remaining 10% are for second homes or investor properties. Roughly half of all purchase mortgages are for first-time home buyers who rely mainly on government housing programs for their loans. In particular, the FHA supported affordable mortgage financing for more than 478,000 first-time homebuyers in fiscal year 2023, representing more than 82% of its forward mortgage business. Of course, not all homebuyers utilize mortgage financing. Some purchase properties with cash. For existing homes, roughly 28% of buyers purchased with cash in 2023. For new homes, more than 8% were cash buyers. Lenders with different business models tend to focus on distinct types of lending. For example, independent mortgage banks, or IMBs, tend to focus primarily on their growing share of government and conventional loans to first-time home buyers and low and moderate income buyers, while depositories have concentrated more on ARMs and jumbo loans for their retail banking clients that they hold in their portfolios. MBA's members believe the single biggest challenge in today's housing market is the lack of adequate inventory. Housing supply is millions of units short of that needed to support the corresponding demographic demand. Given the lack of housing supply and brisk demand, home prices increased 39% over the 2020 to 2022 timeframe. Mortgage rates reached record lows below 3% during the pandemic. In 2022, to combat inflation, the Federal Reserve briskly raised short-term rates, and 30-year mortgage rates more than doubled in response. The net impact of the higher rates and home prices was a dramatic reduction in affordability. My written statement outlines certain regulatory challenges facing the mortgage market, including the Basel III Endgame proposal's likely impact on mortgage credit, as well as the current cost and lack of availability of homeowners insurance. MBA appreciates the focus on these two issues by the members of this subcommittee. Thank you again for the opportunity to walk through these latest market trends with you, and I look forward to your questions.
Thank you. Dr. Lautz, you are now recognized for 5 minutes to give your oral remarks.
Thank you. Chairman Davidson, Ranking Member Cleaver, and members of the committee, thank you for inviting me to testify today. I'm Jessica Lautz, Deputy Chief Economist and VP of Research at the National Association of Realtors. Real estate is nearly 20% of the U.S. economy. Realtors who serve residential and commercial property consumers are vital to homeownership, which is the bridge to financial security. With the current housing market challenges, consumers know it is critical to have a realtor aid in the transaction, given their enhanced training and subscription to NAR's Code of Ethics. There have been significant legal developments in real estate in the last week that could potentially shift how buyer representatives are compensated. Realtors play a pivotal role in the real estate transaction, especially for first-time and low to moderate income buyers. These shifts in the market could push home buyers without cash to pay for professional representation out of the market. NAR is seeking to clarify that existing mortgage finance rules, which assume seller pay commissions, will continue. If not, limits on seller contributions may need to be adjusted. Veterans using VA loans are also currently prohibited from paying for buyer representation under the department's guidelines. Should the market shift in a way that buyers are expected to pay for representation, veterans could be left out of the market, forced to forego professional representation, or forced to use a different, less favorable loan product. All of this said, I'm an economist, here to discuss housing inventory, the erosion of affordability, and who is entering into the real estate market, and importantly, who has been left out. For further information on legal developments impacting the real estate industry, please visit competition.realtor. In 2023, at just 4 million, the annual number of existing home sales was the lowest recorded since 1995. The housing market continues to have a deficit in inventory compared to demand. In January, there were 1.1 million existing homes available in the market. In comparison, in March of 2020, there were 1.49 million existing homes available. Bidding wars are more frequent. In January, the typical home seller received 2.7 offers, and 16% of homes went over the list price. Home prices continue to rise. From March 2020 to January of 2024, existing home prices have climbed to nearly 36%, while household family income has climbed just 23%. In the fourth quarter of 2023, 15% of metro areas had double-digit home price gains. In conjunction with underbuilding of new inventory, the lock-in effect due to the rise in mortgage interest rates has compounded the problem. Home buyers who purchased a $350,000 home at a 3.5% interest rate compared to a 7% interest rate are looking at a mortgage payment that has increased by $683 per month. Even with a new job or a family change, an owner may be financially unable to move. Not all buyers are affected by mortgage interest rates. In January, 32% of buyers did not use a mortgage to finance their purchase. This is the highest share since June of 2014. First-time homebuyers struggle to enter into the housing market as they lack housing equity. First-time homebuyers accounted for 32% of primary residence buyers last year, while the historical norm is 40%. First-time homebuyers are older, with higher incomes, and more apt to use financial assets for their down payment today. In the 1980s, the typical first-time homebuyer was in their late 20s. They are now in their mid-30s. First-time homebuyers who bought in the last year had household incomes that were $25,000 more than the past year. Teachers and firefighters are being priced out of buying homes in their local communities. While it's hard to obtain home ownership, the typical homeowner has benefited from the rise in prices. The typical net worth of a homeowner in 2022 is nearly $400,000 compared to that of a renter of just over $10,000. Thus, the wealth held by homeowners is 40 times that of a renter. Housing wealth can be helped for children to attend college, to buy a home for their own retirement. The homeownership rate has risen for each racial and ethnic group in the last decade, with Asian and Hispanic households reaching all-time highs. However, despite these gains, there remains a 28% percentage point gap between white and Black households. For many, the financial benefits of and potential pathway into homeownership are unknown. Since 2009, the share of successful homebuyers who used FHA financing has dropped by half. For prospective homebuyers, many are unaware of low down payment products that could bring homeownership closer within reach. Thank you for the opportunity to share my views today.
Thank you, Dr. Lautz. Ms. Bailey, you're now recognized for 5 minutes to give your oral remarks.
Chair Davidson, Ranking Member Cleaver, Ranking Member Waters, and members of the subcommittee, thank you for the opportunity to testify today. I am Nikitra Bailey, Executive Vice President of the National Fair Housing Alliance. NAFA leads the fair housing movement throughout the United States, representing over 170 local fair housing enforcement agencies. NAFA's members serve on the front lines combating millions of incidents of housing discrimination. The nation is faced with a fair and affordable housing crisis that is squeezing the budgets of everyday people, particularly consumers of color. Low housing inventory, record competition from corporate investors, exclusionary zoning ordinances, high interest rates, and more are all driving up prices. The Federal Reserve Board does not have the tools to address these housing challenges. While the Federal Reserve attempted several deflationary efforts, housing costs continue to skyrocket. And Federal Reserve Chair Powell recently stated progress on lowering inflation is not assured. Further, data shows housing will continue to be a major driver of inflation, and its impact will not subside until the end of 2024 and beyond. Thus, Congress and the Biden administration must act quickly to make equitable housing investments that promote financial inclusion and stimulate economic growth for everyone. Homeownership has long been the primary way that most families build wealth and achieve economic stability. However, thousands of race-conscious housing, banking, and other policies created systems and structures that were highly inequitable and mostly to the benefit of white Americans. Even after passage of the Fair Housing Act in '68 and Equal Credit Opportunity Act in '74, policies of the federal government and private actors continue to perpetuate segregation and discrimination. Explicitly race-based policies were replaced with subtler race-neutral methods of excluding people of color. These policies and practices created today's persistent and growing racial homeownership and wealth gaps, where white homeownership and its rate is nearly 67% higher than the Black homeownership rate, 45% higher than the Latino homeownership rate, and 20% higher than the rate for Asian American communities. Mortgage discrimination is not a relic of the past. The Department of Justice's recent record settlements totaling more than $100 million in redlining cases in Black and Latino neighborhoods nationwide is a stark reminder that redlining persists and underscores the importance of using all of the tools at our disposal to root it out. Even technological homeownership decisions perpetuate bias. Researchers at UC Berkeley found that algorithmic systems overcharge Black and Latino mortgage borrowers $765 million annually, and automated valuation models perpetuate discrimination against homeowners of color. People of color continue to share stories of having to whitewash their homes to receive fair and accurate appraisals. Can you imagine having to remove your personhood from your home, which is also the family's largest asset? In 2021, homes in white neighborhoods were appraised at values nearly 250% higher than homes in similar Black neighborhoods, and values nearly 278% higher than similar homes in similar Latino neighborhoods within the same metropolitan areas, depriving households of color of opportunities to build wealth. Overall, white communities have access to over $15 trillion more in capital because of racialized appraisal practices. There are solutions that are already working in forward-thinking states like Minnesota, Maine, Vermont, and others. Congress can follow their lead and remove barriers that stymie progress and center housing as the path to restorative justice and inclusive growth. The Homeowner Assistance Fund is an example of Congress doing just that by helping over 400,000 hardest-hit homeowners remain housed during the COVID pandemic. Half, along with sensible mortgage servicing reforms supported broadly by the housing sector, were instrumental in thwarting another foreclosure crisis like the one that occurred in 2008. Further, inclusive policies like the Equal Credit Opportunity Act special purpose credit programs helped to increase Black homeownership by 13% and Latino homeownership rates by 7% between 2019 and 2023. We actually partnered with our colleagues at MBA to create a special purpose credit program toolkit to assist lenders with properly developing programs. All future net household growth will be from households of color, and white homeownership is set to decline. With housing accounting for nearly 20% of the United States GDP, Congress must advance inclusive policies so that the housing market and economy are not jeopardized. My written testimony details other solutions, and I look forward to discussing them with you. Thank you.
We'll now turn to member questions. I recognize myself for 5 minutes. This week in a story about the lingering impact COVID has had on our economy, the Washington Post reported, quote, "A new normal has settled into the U.S. economy, one that nobody could have predicted. The pandemic's impact on housing, quote, set off a home buying frenzy that resulted in, quote, a stunning 48% surge in home prices that lifted the average U.S. sales price to over $552,000, end quote. As these prices have gone up, wages have not kept pace, and people don't believe it's going to be transitory. Nationwide, median home prices are now nearly 6 times the median household income, despite historic levels of government intervention in housing markets. Dr. Lautz, what do these shifts mean for the American middle-class family looking to buy or sell a home? What does the data tell us about how they are reacting to this increasingly expensive new normal?
Thank you so much for the question. So traditionally, when we look at our data dating back to 1981, the typical home buyer who's placing 20% down would be putting 20% of their household income towards housing. Unfortunately, we know that that has pushed up more than 23% in recent months, 28% even. It is coming down, and that's a good thing. And the reason it has come down slightly is because interest rates have come down by a full percentage point since October. That being said, the price of housing is due to the supply out and demand outpacing that supply. So when we look at multiple offer situations, especially as we go into the spring months, we suspect that they'll heat up again because consumers are interested in purchasing a home. The demand for housing is there. We also know that we're at a really critical time point as we have a lot of young millennials who are trying to enter into the housing market at the same time that retirees are looking for a retirement property, and that's putting a lot of demand for housing into the market.
Thank you. As borrowers attempt to grapple with the economic realities of this housing market, it seems clear that some are resorting to alternative ways to manage their higher housing costs. For some, that might mean resorting to co-buying arrangements or supplementing their incomes with something known as accessory dwelling units, kind of multiple properties on one lot. For others, they might pursue other less traditional pathways to finance a mortgage beyond the government-backed channels like the GSEs or FHA. Dr. Fratantoni, can you speak to how we are seeing, what we're seeing in the marketplace on some of the non-traditional ways that borrowers and lenders finance homes?
Yeah, I think I would be sense to first to highlight that borrowers are using the traditional methods as well. So we're seeing many lenders, their FHA share of their business has increased, and then within that FHA, you've seen debt-to-income ratios increase because of the strains that you're talking about. Outside of that, I mentioned in my testimony some growth in the non-QM market, which do provide some additional underwriting flexibilities, but I would still characterize it as a very small portion of the market, and the flexibilities as limited. I think the structure we're operating today, the entire market is much safer, certainly than we were 15 years ago as a result of the safeguards that have been put in place, and I think those are holding even in this tough environment.
Yeah, thank you for that. And you talk about one of the dynamics of the market years ago in the great financial crisis is structured credit and the role that plays in our market. So one of the most pressing issues impacting housing affordability right now is the lack of supply in the single-family market. Data from the Federal Reserve of St. Louis shows that the average 30-year fixed mortgage rate has increased from 3.3% in 2020 to roughly 7% today. That's a 110% increase just in that span. As a result, something like 80% of homeowners currently have mortgage rates below 5% and a huge number below 4%. So Americans have difficulty deciding to sell a home that they've got a mortgage rate that's low locked into, and they're not putting it on the market. So some have said, well, what if it was transferable or assumable? Somebody could assume your mortgage. Of course, the structured credit market in our country, these risks have already been sold off, and so it makes it hard to price that risk. So, Dr. Fratantoni, how could a secondary market develop? How could we maybe get a way to price that risk in a secondary market? Do you have any thoughts?
Yeah. So as you know, FHA and VA mortgages are assumable, but today for a buyer to take that loan, oftentimes they'll need an additional amount to meet the purchase price given the home price gains that we've seen, and that would have to either come from cash or a second loan. If we were to move the conventional market back to where it was, prior to the late 1980s of having an assumable feature, again, we'd have to do that on a prospective basis. We couldn't address the loans that have 3% rates today.
Thank you. My time has expired, and I now recognize the ranking member from Missouri, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. Ms. Lautz, thank you for being here. Last week, there was an agreement by the National Association of Realtors to settle home seller claims regarding commissions. You mentioned in your testimony the term legal developments, and you note that NAR is seeking to clarify the existing mortgage finance rules, which assumes that sellers would pay commissions, will continue. If not, limits on sellers' contributions may need to be adjusted. Now, the American Banker, from my perspective, predictably, had an article today entitled, "NAR changes could hurt home buyers." So the sky is falling. Chicken Little comes out to talk. Could you clarify the remarks you included in your witness testimony and how any changes may impact the home buying market?
Absolutely. So the first thing I will say is this is obviously currently in action right now in settlement, and so there will be progress on this. And I'm not the general counsel. But what I will also say is that when we think about first-time homebuyers, they need the ability to have representation and to move forward with that transaction. And they need the ability to have this representation in a very competitive housing market. And so as they think about the person who's going to represent them, their commission is always negotiable in that transaction, but they need the ability to move forward so that they can even have their offer seen when there continues to be multiple offer situations and get them to that closing table. But we are concerned about first-time home buyers, low-income buyers, moderate income buyers, and VA buyers especially.
Yeah, I'm just always concerned about the fuzziness when these kinds of decisions are made. Because after you read it 3 times, maybe the decision wasn't made. Anyway, it's giving me a headache. But Ms. Bailey, your testimony notes that appraisal bias continues to undercut wealth-building opportunities for families of color. And as you note, white communities have access to over $15 trillion with a T, more in capital because of racialized appraisal practices. How are the regulators doing in terms of meeting the goals of PAVE action plan?
We are encouraging them, and thank you so much for the question. We are encouraging them to finish the race. PAVE is a very important initiative that was designed to help us address and end appraisal bias. And we absolutely need to make sure that the regulators follow through with the work that they started. And some of the things that we want to make sure is that we get HUD to resolve the backlog of appraisal discrimination complaints and the feasibility of releasing to the public the property level uniform appraisal data set from the Federal Housing Finance Agency and the Federal Housing Administration and the U.S. Department of Veterans Affairs and U.S. Department of Ag. This data really lets us know what's going on. We're in a situation where appraisals are not fair and they're not accurate. And because families have to whitewash and remove themselves, that's the only way they believe they can actually get a fair and accurate appraisal. So we need these important actions to take place so we can finish the process and make sure we're actually doing the things that PAVE was designed to do, which is really end appraisal bias. And we want to commend the administration for being very bold. This wasn't an easy thing to arrive at. It took a lot of courage. So we are really hopeful that they will continue to run this race and complete the task.
Yeah, I share that same optimism. Now, let me just stay with you for a minute, and I hate my time is running down low, but because this is so important, there's $82 trillion currently invested in private equity and venture capital, And of that 82 trillion, less than 1% of that money invested in firms are owned by minorities. That means 99% of all private equity and venture capital goes to firms that are owned by people, or not owned by people of color. Given that disturbing reality, what more can we do? I mean, we pass laws that the problems just seems to hang on and hang on and hang on.
It's misguided to not understand that diversity actually benefits all of us. Diverse companies that have psychological safety outperform non-diverse entities. We want to make sure America remains on the leading edge. Diversity and inclusion is our way forward.
Thank you very much.
Thank the ranking member. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman, and I want to thank you and staff for doing the research necessary to bring some expert witnesses in here that believe there are ways to solve the challenges of today's home buyers without the federal government simply throwing more money that it doesn't have, that it would have to borrow to solve some of the issues. Drs. Fratantoni and Dr. Lautz, please summarize, each of you, the impact of inflationary finance on housing affordability over the past 3 years.
Yeah, so as I mentioned in my testimony, that to counter that inflation, the Fed rapidly raised short-term rates, and we saw mortgage rates more than double in response. You couple that with the rapid increase in home prices, we've seen a median principal and interest on a mortgage payment go up more than $900 on a mortgage. So again, really eating into affordability because obviously wages have not grown nearly as fast.
Okay. Dr. Lautz?
Thank you. And the only thing that I would add to Dr. Fratantoni is that when we look at the component of rent to CPI, it's 7 to 8%. So as individuals are seeing their rents go up, they're, one, hit by that financially and having a harder time, secondarily, saving for their own down payment for a mortgage. So it's a double hit for renters currently.
For sure. Same two witnesses, a question. Do you think when inflation is tamed that we'll go back to more reasonable rates and the effect it will have on the market at that time?
Yeah, so we do expect that inflation is going to continue to decrease per the Fed's goal of getting it back to 2% over the next couple of years. And as that happens, expect that longer-term interest rates will edge down over time, not quickly, right, but over time. But given the structural undersupply in the market, we certainly don't expect home prices are going to decline. If we get some additional supply from builders, maybe the rate of home price growth will slow. But I think this level of home prices is baked in most of the country now.
Dr. Lautz?
Yes, still in agreement. So looking at mortgage interest rates, we do expect that hopefully in the second half of the year, we will see them come down. But unfortunately, they've been stuck in the 6% range for the last 14 weeks. So that is hitting affordability. If we look at interest rates, though, historically, we do know that we're a full percentage point under the historical norms since 1971. So we are at a lower point, but I think we also have to remember that when we think about the lock-in effect of those 2% and 3% interest rates, it's very difficult to fathom someone being able to financially move.
Okay, yeah, you both alluded to it, but would you care to further comment on how the long-term interest rates determine the course of the housing market going forward?
Yeah, so Dr. Lautz mentioned the lock-in effect. So a homeowner that was able to refinance into a low 3 or high 2 mortgage rate is just much less likely to list their property. It doesn't mean they're never going to list. Life keeps happening. People still keep getting married, having children, getting new jobs, and they might have to leave that low rate behind. But it's a friction in the system. So it's going to keep existing inventory much lower than it otherwise would be. And that's been a support to home prices. But for someone trying to get into the market, it's really an obstacle.
Very good. Dr. Lautz?
Absolutely, and the lock-in effect is absolutely happening, but life changes do happen as well, and it's generally the number one reason why someone does move, is because a life change has happened. I will also say that it is likely to impact first-time homebuyers more than repeat buyers, because repeat buyers continue to gain housing equity, where first-time homebuyers do not have that housing equity to rely on.
Thank you. Dr. Lautz, in an effort to mitigate increasing prices, What do you think Congress and local governments can do to help remove the obstacles for achieving the benefits of building modular home construction?
Certainly, I think that there's a lot of new home products that could come onto the market, and I think it's really important to note, too, that while there's a lot of new homes that have been built over the course of the last year, at least more ramped up building than we have seen the decade prior, that we need all sorts of home products, because we do know right now that there's a larger share of single households. There's a larger share of first-time home buyers trying to enter into the market, young adults, but also seniors who may need a smaller property as well. So not the traditional large single-family home on the market.
Thank you very much. Mr. Chairman, my time is about to expire. I'll yield back.
I think, Mr. Posey, the ranking member from California, Ms. Waters, is now recognized for 5 minutes.
Thank you so very much, Mr. Chairman, for this hearing, and I'd like to thank Mr. Cleaver for all of the hard work that he's putting into dealing with these housing issues and this housing crisis. Let me ask each of our witnesses here today, do you support the Down Payment Toward Equity Act? Do you think it's important to have assistance for down payments? Ms. Bale?
Yes.
Thank you.
Yes, but we also do need more supply.
Okay, Mr. What is it, Fratantoni?
Yeah, similarly, we support down payment assistance, but agree that supply is the bigger challenge right now.
Okay, very good. Let me ask another question. I'm going to direct this to you, Mr. Fratantoni, and that is, do you know or understand that banks do not give mortgages for low-cost homes? For example, I discovered in Ferguson, right outside of St. Louis, for example, there were homes for $80,000, $90,000 after they had the big incident there. These people could not get mortgages for the most part. And so private equity and others came in and they bought them up, and then they rented them back. People were paying more rent than they would have paid in mortgages. Do you know why banks do not afford mortgages for low-cost homes?
Yeah, I wrote about this to some extent in our written testimony, and we did a research study last year looking really at what are the drivers of that, right? You think there are a lot of fixed costs to making a mortgage, and it makes it much more difficult for a lender to make that loan economically if the loan balance is really very small. And unfortunately, it works exactly to the detriment that you're talking about. It makes it much more difficult to finance properties in these more affordable parts of the country. Some of that you can directly tie to some of the regulatory changes that have been made that have added to some of the fixed costs in the business.
Thank you. I do believe that based on what we understand about the profit margins of the banks, they could really afford to do it. They may not get as much return on their investment if they were doing a jumbo, but I think that in the interest of affordable housing and secure housing for the people of this country, they should be able to do it, and I think we should put more attention to that. Let me just say that I have 3 bills, and the Down Payment Toward Equity Act is but one of them. The others are the Housing Crisis Response Act. Are you familiar with that?
I am, and wish the Build Back Better Act had actually passed in the prior time it was offered, because had we passed the Build Back Better Act, we would have had $150 billion to address the nation's fair and affordable housing crisis, and we would have gotten the kind of relief to consumers.
Thank you so very much. I'm still mourning about the loss of that at the hands of 2 Democrats on the Senate side. Let me ask our real estate representative here today, are you familiar with all 3 of these bills?
I am personally not, no.
Are you familiar with the Housing Crisis Response Act?
I am not. I'm an economist.
Okay, the Ending Homelessness Act.
Yes, I am familiar with that.
Okay, and you already said you know about the Down Payment Toward Equity Act. Mm-hmm. So I'm very pleased about that. And let me ask Mr. Fratantoni, are you familiar with all these bills?
Not familiar with the bills. Sorry.
Well, first of all, I want to thank you all for being here. I really do appreciate the knowledge that you have, but I'd like you to take a look at my 3 bills. You already know about them. You just talked about Build Back Better with the $150 billion that we had in that. And in getting to know them better, I would hope that you could also become activists in terms of advocating if we want to really deal with doing something about housing. Now, it should be a bipartisan bill. What can you do to help the Republicans understand that their constituents are also in a crisis in many parts of this country, and they should be supporting this? Can you think of anything else we can do that would convince them that they should support us on these bills, or any that they could come up with, in order to produce more housing in this crisis? Yes, ma'am.
Yes, I think if we pass the $10 billion in the Housing Crisis Response Act, it should be noted that 960,000 Black, 96,000 Black, 83,000 white, 75,000 Latino, and 29,000 Asian Americans in rural and urban communities would benefit from the overall passage of that legislation.
So this is not for any one ethnic group. This is for everybody, because we have a crisis in this country, and we know a lot about what it takes: money, support, and getting it done.
The
I yield back the
gentleladies.
balance of my time.
Thank the gentlelady. The gentleman from Wisconsin, Mr. Fitzgerald, is now recognized for 5 minutes.
Thank you, Mr. Chair. So I guess I'd start by asking the witness panel to raise their hand if they agree that all else being equal, boosting demand while doing nothing to increase supply leads to higher prices. Is that right? Does everybody agree with that statement? So we have a situation where the supply of homes on the market is out of reach for many young adults. I talk to builders in my district all the time. They have a similar story. Municipality or a village approaches them about building a new subdivision. By the time the in-ground costs are added to any of the additional infrastructure that they would either have to pass through or be responsible for, they end up with an average cost of about $500,000 per home. So what happens? A lot of times, everybody just walks away and nothing happens. There's no new homes that are built. So we have a situation where the supply of homes on the market is out of reach for many young adults, certainly, as builders are not, they're just not incentivized to build the homes. And so far, the administration's solution to the problem is kind of the host, and I know this has been discussed today, to boost demand. It's like we're trying to make sure that there's more consumers, which doesn't make any sense to me when we have this supply issue, right? So, Dr. Fratantoni, President Biden's proposal of a $10,000 tax credit for those who sell their home below the median price in the country. So if these sellers become buyers, is this likely to have any effect at all on the supply of homes?
I'd say this first, we do appreciate the bipartisan focus on the housing market and really welcome the attention it's getting, because we've seen this issue bubbling up for multiple years now, but agree that the lack of supply is the problem right now. Don't think that this one particular approach is going to solve that problem. We are millions of units behind.
And then what about the proposed $5,000 tax credit for first-time homebuyers? I mean, I know. I have 3 sons. They're in their 30s, and they all have different situations, obviously. But a $5,000 tax credit is not going to be the game changer that's going to allow them or any other adults between 25 and 35 to jump into the homebuyer market right now.
Yeah, I mean, many of our members tell me that they have a long list of potential buyers who are pre-qualified or credit qualified to get a loan, but just can't find a property. That's the problem in today's market.
Yeah, and the proposed $25,000 down payment assistance for first-generation homebuyers, it's not going to do anything either. It's not going to have an impact on the market. We've got to get more supply. So let me just say, would the CFPB prohibiting certain closing costs set by lenders only serve to increase the compliance burden on landlords, leading to increased costs, more consolidation, fewer choices, and higher rents? I think the answer to that is yes. Is that?
Yeah, and I mentioned the challenges that lenders already have originating small balance loans. Adding to the cost of lending would just make that more challenging.
Yeah, and I think some of the things that the president, the administration is proposing right now will make that worse. Last month, at the direction of FHFA, Fannie Mae, and Freddie Mac, they released a bulletin clarifying requirements for lenders of mortgage services with respect to verification of homeowners' insurance. Generally, the bulletin requires services each year to verify the replacement cost value of all properties secured by loans sold to Fannie and to Freddie. Servicers have expressed concerns that this new policy is not operationally feasible, and it's not a good way to verify the replacement value cost, and it could actually significantly increase the cost of insurance. Dr. Fratantoni, does MBA also share these concerns?
We absolutely do, and we've been working with folks at FHFA to try to address our concerns, and at a minimum, we need a delay in the implementation time to make sure lenders can become compliant with this new requirement.
Thank you very much. I yield back, Chairman.
Thank the gentleman. The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you. Ms. Bailey, do you believe that exclusionary zoning has a disparate impact on communities of color?
Yes,
Does the Fair Housing Act prohibit disparate impact discrimination?
yes,
Do you believe that exclusionary zoning, in as much as it produces a disparate impact, violates the Fair Housing Act?
yes,
Do you believe that HUD should enforce the Fair Housing Act against exclusionary zoning?
yes. And I need to clarify that a lot of the challenges at the local level are based on local laws and lot sizes. And if we were able to actually have localities be incentivized with the $85 million that HUD is using to try to incentivize the localities to change those laws, we could actually increase opportunities to address the fair and affordable housing crisis.
But even though zoning is a state and local issue, if it violates the Fair Housing Act, it becomes a federal constitutional concern, right?
Yes,
Okay. I think we all agree that there's an urgent need to expand housing supply. Expanded housing supply will require greater housing subsidy from the federal government and greater land use reform from state and local governments, but there's a third variable that affects housing supply: cost. If we can figure out how to cut the actual cost of housing development in half, then in theory, we could cut rent, maintenance, mortgage payments in half. So a question for each of you: what is the most promising strategy that you have seen for fundamentally reducing the cost of housing development and housing construction in America? And we'll start with the Mortgage Bankers Association.
Yeah, so I think it's been interesting to see in Massachusetts, California, other parts of the country, the state level government really sort of leaning into local governments to try to increase density. And I think that's probably the most effective way this is going to be done at the state and local level, is just where it makes sense, increase density.
Increasing density is certainly important, but I also think that when we look at building more homes, we have to look at the other problems that are holding back building. Certainly, there are local laws that are restricting building and holding that back that go beyond density. And so looking at those laws, I think is quite important, like the number of shrubs and trees that need to be planted on a lot to have a single-family home go in, things like that really could expand the number of homes.
fully enforcing our nation's civil rights laws. There is a provision, the Affirmatively Furthering Fair Housing provision under the Fair Housing Act. It requires two things: for localities and states that are receiving federal dollars for housing and community development to stop discriminating and then to create inclusive communities going forward. We've yet to have full enforcement, quite frankly, because HUD has been under-resourced by the prior administration. And HUD during this administration had to do yeoman's work to really build up the staffing at the Office of Fair Housing and Equal Opportunity to really approach this work with the rigor that's required. And if I may just speak to one issue about where we are in terms of building and costs. We didn't arrive at here by an accident. We actually underbuilt following the Great Recession. Builders actually built homes at the higher end of the marketplace, excluding building opportunities at the lower end of the marketplace. So we didn't just come here from an accident where we need to now focus on supply-side strategies. By failing to focus on demand-side strategies, we've exacerbated and actually grown the crisis. If the House had passed the Build Back Better Act, which is now the legislation that the ranking member mentioned, the Housing Crisis Response Act, if we had passed that legislation, millions of consumers would have got the housing relief that they need, and the overall market would be stronger.
I have a question about the relationship between median home prices and median household incomes. Median home prices have been stagnating. Median home prices have been rising astronomically, whereas median household incomes have been stagnating, and the gap between prices and incomes have been widening. Like, at what point does that gap become unsustainable? What is a healthy ratio of home price to household income? Yeah, Dr. Lautz, if you want to.
So I think when we're looking at this, we have to keep in mind that while first-time homebuyers are really struggling to enter into the market, homeowners have had incredible wealth gains. And so 32% of the market paying all cash, a quarter of repeat home buyers who are primary residence buyers are paying all cash. They're not going to be wedded as much to what their income is versus the gain in home prices because of the ability to gain equity over time and make this all cash purchase. And right now, we are seeing a lot of boomers do this.
And many of these people have the ability to pay all cash because the Fed's policies to rescue the market during COVID did not land equally in every community. Wealthier borrowers were able to take advantage of refinances at historically low rates, whereas borrowers of color were not able to do so. So we saw the black homeownership rate actually, black-white rate, homeownership wealth gap rather, grow by $20 trillion because of those inequitable policies.
Thank you.
The gentleman from New York, Mr. Garbarino, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you to the witnesses for being here today. Dr. Fratantoni, the purpose of this hearing is to examine the challenges facing today's homebuyers. So I want to talk to you about title insurance. FHFA recently announced a pilot program that would allow Fannie Mae to effectively self-insure the title on mortgages it backs. Curiously, FHFA's announcement said the pilot would reduce costs for lower-income households, but then went on to say it would be limited to low-risk refinances. In other words, borrowers who already own a home and have substantial equity. Can you make heads or tails of this apparent contradiction in the Biden administration's new government-run title insurance program? Put another way, do you believe that eliminating insurance for refinances will help first-time home buyers purchase their first home?
Yeah, so short answer is no. Title insurance, as you know, provides critical protections for the real estate finance system, borrowers, lenders, investors, by authenticating the parties at closing, confirming the authenticity of the transaction documents, and ensuring that the property being mortgaged is free of other debts. Title insurers provide insurance against future legal actions against the proper property ownership and mortgage priority. You know, for decades, MBA has had a policy that there should be a bright line between the secondary market activities that Fannie Mae and Freddie Mac are rightly involved in, providing liquidity to the market, and primary market activities that lenders, title insurers, others, using private capital, taking risk, are involved in. And we think this is another example of the GSEs potentially extending beyond the secondary market activities where they really are intended to be focusing their efforts under their congressional charters.
Yeah, absolutely, and I can't speak enough about how important title insurance is. I was a real estate attorney before I came to Congress. I did hundreds of closings, probably thousands of closings, and I've seen at the closing table, the title closer's there. They're not just making sure all the bank paper. They make sure the deed's filed. They make sure everything's written out properly. You go through. You make sure there's no there's no liens on the property. They check the COs. They make sure. I mean, they do a lot. And I think waiving this and this pilot program, it starts just with refinances, but they've said they don't know where it could go. Replacing title insurance or getting rid of it for Fannie or Freddie could really hurt the consumer, because Fannie and Freddie is only interested as long as they back the loan. But title problems could come up much later down the line. So this is a real. I think this could be a real issue for homeowners, and actually could work against them. Just so could save a couple pennies at a closing. In the grand scheme of things, could cost a homeowner once this a lot of money in the long run. I would like to submit for the record, Mr. Chairman, a letter written by former Obama-era FHFA Director Ed DeMarco expressing caution on this very subject.
Without objection.
Thank you. Next, I want to move over to how we can encourage innovation in the mortgage interest market. We've heard a lot today about the challenges that first-time home buyers face when attempting to enter the market. My constituents face the same thing, actually, in New York. The latest stats have that New York has the lowest percentage of homeowners in the nation, under 55%. Given this, the goal should be to lower costs for New Yorkers, especially when it involves bringing in new private capital to create more options for consumers. One way to reduce prices in the housing space could be through a new model for providing mortgage insurance designed to create more flexibility and pricing for borrowers. By utilizing a new, streamlined, highly capitalized approach, direct mortgage insurance is estimated to save homebuyers $6,000 and reduce taxpayer exposure for the GSEs. Dr. Lautz or Dr. Fratantoni, or both of you, as homeownership has become increasingly unaffordable due to elevated prices and persistently high interest rates, do either of you believe that we should not be looking at new, innovative mortgage products to make add-on costs as competitive as possible?
I can take this first. We absolutely need to be looking at innovation. We have to be looking at innovation in every aspect to be bringing in new home buyers, and not just first-time home buyers. We also need to be thinking about retirees who want to downsize as well.
I guess I would be more cautious, right? I think that the mortgage industry has learned the lessons from 15 years ago very well, and I think there's a genuine cautious there to make sure we're not overextending ourselves once again.
Thank you very much. My time's expired. I yield back.
Thank the gentleman from New York. The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thank you to all the witnesses for being here today. As we have heard, housing is the #1 driver of inflation and continues to outpace wage gains. Our nation is facing a housing crisis, and this committee did constant work on the issue under the leadership of then Chair Waters. Yet the Republican majority has chosen to delay working toward legislative solutions to address the housing affordability crisis. In the greater Houston area where my district is, there are only 33,000 affordable homes or places to rent for more than 217,000 extremely low-income renters. 83% of these extremely low-income households spend more than 50% of their income on housing. Ms. Bailey, given the high demand for affordable housing options in many communities across our districts, including my own, what types of housing are needed to close the housing supply gap?
Thank you for the question. We need to make sure we are thinking about the missing middle. Right now, there's an opportunity for us to bring in things like accessory dwelling units. And while those are important opportunities in community to help lower overall housing costs, financing still becomes a major challenge for consumers of color. And that's why we keep saying it's a fair and affordable housing crisis. We need to make sure consumers of color are not locked out of accessing credit on a fair basis, which they currently are. The recent record settlements by the Department of Justice shows that we continue to see discrimination in the marketplace. So we need to make sure we're focusing on the missing middle. And then we need to utilize programs like first-generation programs. These are programs designed for people whose prior generations were locked out of homeownership opportunity and who don't come with the kind of background to the housing sector that others might have when they arrive. First-generation down payment assistance in the Housing Crisis Response Act would help rural and urban borrowers access homeownership. And if we pass it at the level of the Down Payment Toward Equity Act, we would actually grow homeownership by 5 million new homebuyers. 1.7 million of them would be Black, 1.4 million of them would be white, and 1.32 million of them would be Latino. And we need inclusive policies like that to give people a chance to run up against investors who are really making it very difficult for first-generation home buyers to enter into the marketplace.
Mm-hmm. And to follow up, can you speak to whether the private market can solve the housing crisis on its own, or as one of my colleagues from the other side referenced, without the government getting involved? Can the private industry solve the housing crisis on their own?
Do you remember the Great Recession of 2008? That's the only time our housing market was purely private. And that led to the United States housing market crashing and a global collapse. We need an all-out, everything and approach. This is $150 billion in the Housing Crisis Response Act. $150 billion that we've all negotiated. We've done all the backdoor conversations. That is a compromise. That is a solution that would help millions of consumers all over the nations. And it would help jumpstart the economy. We keep saying housing is 20% of the U.S.'s GDP. If housing tanks, the economy tanks, and we don't want to return to that.
Mm-hmm. So are there any other considerations that need to be made by Congress, for example, to help address and increase the limited supply of affordable housing?
Yes, passing comprehensive legislation. There was not any bipartisan support for the Build Back Better Act, sadly. We're asking today for there to be bipartisan support for the Housing Crisis Response Act, the Down Payment Toward Equity Act, and all of those other very sensible provisions. They're not outlandish. They're not tons of money thrown at a problem. They're very practical things that would keep the housing sector safe. Again, we are looking at a housing sector where, in terms of homeownership, white homeownership is set to decline. So if borrowers of color are locked out of fairly accessing credit, that means seniors won't be able to have anyone to sell their homes to reach a successful retirement. That means overall instability, and we don't want an outcome like that.
Right, is there any other considerations that we should take when it comes to housing for seniors or for veterans?
We want to make sure we are supporting things like housing choice vouchers. Seniors and veterans often rely on those programs, and we have been calling on the GSEs to really make sure in their contracts with multifamily unit developers that they are making sure that there will be no discrimination against housing choice voucher holders.
Okay, well, thank you. I see I'm down to less than 10 seconds, so I might as well yield because I won't even get a question out in that time. I yield back, Mr. Chair.
I thank the gentlelady. The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank each one of you for coming. You know, for one who's been in the business for a long time, I built hundreds of houses. I don't know what affordable is. I absolutely don't know what affordable is. I will tell you this, if you want to solve the housing crisis, and it affects, it's not affecting one segment more than the other. White, black, red, it doesn't matter. I'm from South Carolina. We have people moving in. I've got lots that are paid for that I can't afford to build them at cost. Whether it's 1,000 square feet or whether it's 5,000 square feet, doesn't matter. Now, if you really want to solve it, it's not the government. It's not subsidized down payment. It's not doing away with title insurance. It's not, accusing banks of discrimination. Banks, when they, make loans, they sub this out to other groups. They don't know who it is. When I build houses, I don't know who looked at the house. But if you really want to get to the root of it, gas prices. Everything that goes into a house is powered by gas. This administration has killed us on that. Secondly, if you really want to help people afford a house, give them more of their money to spend. Name me one person in this country that's not paying more for eggs, for gas, as I mentioned, across the board. And that's a determination on what they can afford. And I will tell you the demand is there, but until this, and it's directly a result of this administration's stupid rules and regulations, and I can't get copper pipe because they've ruled most states, Arizona being one of them, they've taken it off made it so hard to mine copper. And it goes down the line. We've canceled I don't know how many projects because of supply chain shortages. If I can't get a meter base, does it make sense for me to build a house so I can't get a electrical meter base? Time is money, and that's what the government's the last thing you want. And I would ask anybody that wants the government involved, where are we going to get the money? This country's bankrupt as it is. So the housing crisis, if you get the gas prices, let us get our own gas and oil here in the U.S., and get the supply chain shortages out of the way, you'll see housing maybe not boom, but you'll see it come back. It's not more government spending. Government gets in the way. The regulations, the NHAB say that on regulations imposed by government at all levels account for $93,870 of the final price for new family single family house. That's a fact. Of the $93,870, $41,330 is due to higher prices for the finished lot. That's our fault for not getting with the planning commissions and saying, no, on a lot that's perfectly flat, you don't have to have all these things that go into just bureaucratic red tape. So anyway, any other regulations y'all would say from your end of it? I'm running out of time, but starting here.
Again, I did mention that one of the real obstacles to getting more small balance loans originated in this country is the cost of the regulations that are just added to the fixed cost that a lender has to hurdle over in order to get that loan done. So I agree with your thoughts of land, labor, lumber, all the challenges to a builder that then just ultimately gets brought out in the price of the home.
We've heard from the home builders as well that one of the big hurdles that they're having is that their skilled labor, the median age is well into their 50s. And so we really need to be educating, perhaps this is a pathway to a career choice for young adults to bring them into skilled labor, to bring more homes into the market.
Ms. Bailey?
I think, again, fully enforcing our nation's fair housing and lending laws are the solution to solving our nation's fair and affordable housing crisis. When we fully enforce those laws, we actually make sure people have the ability to have housing choice and they can live in all communities and thrive. And currently, we don't well-resource HUD in a way that they can actually do its job. And our local fair housing enforcement agencies are fighting over 4 million incidents of housing discrimination every year. We need to get more support to them so that they can help people with disabilities, women, families with children, people of color, LGBTQ+, and others avoid discrimination.
Thank y'all.
Thank the gentleman. The gentlewoman from Georgia, Ms. Williams, is now recognized for 5 minutes.
Thank you, Chairman Davidson and Ranking Member Cleaver, for this hearing today, and thank you to our witnesses for joining us. Y'all, I represent Georgia's fighting 5th Congressional District, which is home to Atlanta. The Census Bureau just announced last week that Atlanta continues to grow rapidly, and we're now the 6th largest metropolitan area in the country. You might have seen the signs that says that Atlanta is full, but I welcome everyone who wants to come and call this magical city home and allow Atlanta to change their lives like it changed mine. But y'all, there's one big glaring problem. We don't have enough quality, affordable housing for everyone, and that has generational effects way beyond ensuring that people have a place to lay their heads at night. For decades, home ownership has been how Americans build generational wealth, making it an essential tool for closing the racial wealth gap. Atlanta has many accolades, which I'm sure you'll hear me talk about many times throughout this Congress, but there's one that we don't quite want to be proud of, and that is having one of the widest racial wealth gaps in the country. A gap that could be closed with the opportunity that comes from accessible, affordable home ownership to build that generational wealth. One of the biggest challenges home buyers in Atlanta face is having to compete with large institutional investors purchasing homes in bulk and turning them into rental housing, eliminating the wealth-building potential of each house that they buy. In the third quarter of 2021 alone, institutional investors bought 42.8% of all single-family homes for sale in the Atlanta metro area. This lost opportunity adds up, y'all. According to research published by Georgia Tech, Black communities in Atlanta lost $4 billion, with a B, in home equity over 10 years due to large investors buying properties in Black neighborhoods. And that's why I've co-led the End Hedge Fund Control of American Homes Act, bicameral legislation that would end hedge fund ownership of single-family homes over 10 years. We desperately need this legislation in Atlanta, where Georgia State University has found that 19,000 single-family rental homes are owned by just 3 companies, just 3, y'all, none of which are headquartered in Atlanta. Ms. Bailey, how does the heavy involvement of institutional investors in the housing market contribute to the housing inventory shortage, which we've agreed on a bipartisan level that inventory is a huge problem? How does that impact this, that we're already experiencing?
It's actually driving up all the affordable housing stock in communities that have been hardest hit by the Great Recession. That's the part of this conversation that we're not really talking about. They're actually buying homes for people who would actually be able to afford homes if the market hadn't been overcorrected. We know that following the Great Recession, that there could have been an additional 700,000 Black homeowners, but we overcorrected, we overextended. Those buyers now need first-generation down payment assistance to be able to compete.
Thank you, Ms. Bailey. These investors tend to concentrate their purchasing in low-income communities and communities of color. In other words, areas where buying a home and building equity is the most direct path towards closing the racial wealth gap. Ms. Bailey, how does the presence of institutional investors harm first-time home buyers, especially in marginalized communities, as they are already struggling with the lack of affordable housing?
They make it really difficult for housing costs to come down. So if you're even a renter in those communities, your rents are going up because they're, again, taking advantage of all the available affordable housing stock. So people are paying more money in their rental payments, making it less likely that they'll be able to save for a down payment. Again, we have a solution. The Down Payment Toward Equity Act is one of the solutions, as well as the Housing Crisis Response Act. States like Minnesota, Vermont, Rhode Island, New Jersey, they're all instituting support for first-generation down payment assistance. Even states in the South, like North Carolina, are instituting the support because we understand that people just show up to this equation differently. We've never corrected for our nation's history of discrimination. So while it's uncomfortable talking about black and white when it comes to housing, the reality is we can't escape it. These provisions are restorative and they're race neutral, and they will help to bring economic activity in communities that have long been denied.
Thank you, Ms. Bailey. And we talked about the down payment assistance for first-time home buyers, but what other strategies should Congress examine to help reduce the harm caused by institutional investors' control of so much of the housing market?
I think we need to look at the legislation that you just well discussed to make sure we are monitoring who's being able to purchase in bulk those homes. Again, we need to make sure we're fully enforcing our nation's fair housing and lending laws, the affirmatively furthering fair housing law. Provision under the Fair Housing Act is something that we need to make sure HUD is well equipped to enforce. So that's something. We also need to make sure we're well funding housing choice vouchers so that renters can actually have the ability to get access to quality housing. And we have to talk about things like the low-income housing tax credit. We need to make sure it gives people family choice in terms of where they can actually live.
Thank you, and I'm out of time.
Thank the gentlewoman. The gentleman from Nebraska, Mr. Flood, is now recognized for 5 minutes.
Thank you, Chairman. Before a workforce housing event in Columbus, Nebraska in January, I had the Joint Economic Committee pull some housing data regarding my district before the event. I'd like to use this data to demonstrate the unique environment we're currently in for people that are looking for homes. Using the data provided from a couple of months back, I'd like to take a look at a theoretical example of the problem. Madison, Nebraska is in my home county. The average value of a single unit permitted in this county is $262,238. I was curious, given the current environment, how much would someone need to make in order to be able to afford the monthly payments on that home? If you start with a base assumption that the borrower has a 10% down payment, using the programs and loan products that are out there, you can get a mortgage rate of maybe around 6.805% if you're lucky from a local bank. You add in property taxes, homeowners insurance, mortgage insurance, and now you're looking at roughly $2,081 monthly in housing payments. There's a rule of thumb in personal finance that your monthly housing expenses should not be greater than 30% of your monthly gross income. In order to remain within the scope of the 30% gross income rule of thumb, the borrower's income would need to be $6,938 a month. Annualized, that salary would be $83,257.20 a year. The problem is that the median monthly household income in my county is $5,095 or $61,140 a year. Now, it's worth mentioning that there are ways to get that monthly payment down. If the borrower were able to put 20% down, they'd get a better rate and not have to pay monthly for mortgage insurance, but the general problem remains the same. The cost associated with owning a home remains significantly higher than the median household income of the people in this county. That's the problem we're seeing just in Madison County, Nebraska, and across America. People that work hard should have the chance to live in a home and experience the American dream. One significant part of the problem is that the effective federal funds rate in February was the highest since 2001. In an environment with higher interest rates than we've had in a long time, the question is, how can we make home ownership possible for people trying to climb the economic ladder? Dr. Lautz, do you frequently see a misalignment between the incomes in an area and the same area's housing prices, particularly in a high interest rate environment? Is that something that's becoming more common?
Yes, absolutely. And you're from Nebraska, and I think it's really important to note that we've been seeing this in coastal areas across the nation for years, but now we're starting to see this move inwards. And part of that is because of migration flows that happened during the pandemic. Some of it is because of population growth of young adults, and it's putting a lot of pressure on the underbuilding, which is continuing across the nation.
Second question, how big a role do interest rates play in this environment relative to other factors? The cost of raw materials, cost of labor, general housing shortages. Since 2009, we've seen 16% inflation on building homes in Nebraska. What are interest rates doing to the problems that have been impacting coastal areas and now in inland areas like mine?
So what we consistently hear is that home builders have to borrow to build. They have to finance that project. And so as interest rates went up, it became even more expensive, and they became reticent to actually build more new homes. They're now coming back into the market, but I think it's really important to note that as interest rates are higher than what they have been, they're probably going to be tiptoeing into the market, and we really do need that inventory. 85% of homes that are purchased are existing homes, and those homes are getting older because of the lack of new building.
So what I really focused on are homes that cost between $200,000 and $250,000. That's really the sweet spot, when you look at what our workforce needs. Are you seeing enough building activity for those homes to meet demand? And talk about manufactured housing.
I think the very quick answer is no, we're not seeing enough homes at that very affordable price point. When we're seeing new builds, the typical home price that's being sold is over $400,000. That's not affordable to many communities and to many Americans. As far as manufactured housing, that's one solution to looking at the housing crisis.
Now, I know about Hagerstown, Maryland. I've heard that there's some effort going on there. Any other place in America that's putting together like a development for manufactured housing that people in Nebraska could be looking at to guidance?
I think that's a great case study. I don't have any others off the top of my head.
Well, I would just say this to the rest of America. If you are a city leader, if you are running a city, if you are working on solving this problem, and you've effectively using manufactured housing in a development, please reach out to my office. Let us know. We need to know about it. We need to investigate it. With that, Mr. Chairman, I yield back.
I thank the gentleman. The gentlewoman from Colorado, Ms. Pedersen, is now recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member, for hosting this committee hearing and for all of you being here on such an important issue. I'm from Colorado, as you heard, and like so many states, we are facing a housing crisis. Our secret's out, it's the best place to live, and we have had tens of thousands of people moving there every single month for years. It's finally tapered off because it has become so unaffordable, but it really has impacted especially our rural communities now that remote work is an opportunity for people. They're moving to the mountains, and people that have lived there their entire lives have seen home values increase sometimes threefold in just a couple years, and they're being pushed out of their communities. You know that workers are unable to live in a lot of these communities. It really impacts our small businesses and their ability to attract and retain workers. And so this is something that in the legislature, when I was there for 10 years, it wasn't a big priority of mine. I focused on other issues, but I asked to be on this committee because this really intersects in everything that we're facing in Colorado and so many issues that we're facing. So appreciate the opportunity to chat about solutions. When I think about the urgent needs that our country needs to be addressing, and how complicated these issues are, that is definitely the case for housing. We know that it's the financing piece, and with increased interest rates, as you know, we need homes more than ever, but home builders have started to slow down because of the cost of building. We need to bring the federal incentives that we're actually building the types of homes that we need. In Colorado, we don't have access to seniors, places for seniors to go, so they're staying in the homes that they raise their families in, even though it's really difficult for them to make ends meet and stay in that house. They have nowhere to go, so it doesn't bring room for new families to come into those homes as well. So I'm proud that we finally got something done in a bipartisan way for the LIHTC tax credits. That's really big for Colorado. 4,100 affordable units will either be preserved or built. So that is a big step forward and an example of how critical those public-private partnerships are and what we need to do to incentivize. So I'd love to hear from all of you on what additional things we should be thinking about there. And then how we can address the zoning policies, the restrictive policies at the local level that significantly increase costs. What can we do to bring a carrot and a stick as we can at the federal level? And I just want to thank you for talking about, Dr. Lautz, about what the workforce needs, because we have people who are begging to work here, and we don't provide legal pathways for people to do that. And we have employers who say that this is the #1 thing that we could do to address rising costs, and we can't even come together in a bipartisan way to get that done in a time where it is needed most, which is incredibly frustrating. So thank you for addressing that, because it really impacts construction. So I'd love to hear from all of you, what should we be thinking about broadly on all of these different bucket issues? And then also something that I want to highlight is I had the opportunity, a staggering statistic that I heard from the HUD director was, if we don't act and we don't change policy and we continue down the same path, in just under a decade, over 60% of the housing supply will be owned by corporations. 60% of housing will be owned by corporations. Do we need to think about taking away the opportunity for private equity firms and corporations to buy single-family homes? Is that something that we should be considering? All right, who wants to start?
Congresswoman, I was just with a number of lenders that are in Colorado in January, and I would say something that I know you're aware of that they really focus on as the biggest concern was the lack of availability and cost of homeowners insurance, particularly with the increased wildfire risk in Colorado. So anything you can do to address that problem, it's not only impacting the ability of borrowers to qualify for a loan, but it's increased in payments for existing homeowners to such an extent, it really puts them on an unstable path. So it really is front and center for us right now.
What else are we missing that we should think about?
We would really encourage for Treasury to ensure that those low-income housing tax credit investments are really done in a way that they're built also in communities that are well-resourced to really give consumers the chance to have fair housing. Without that, people can't really choose to live in places with the amenities that are necessary to thrive.
I would add adaptive reuse. We've been talking a lot about new build construction, but I think also repurposing existing buildings.
Sorry, it's a short time. Thank you so much. I yield back.
Thank you for the gentlelady. The gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
Thank you to the chairman and ranking member for holding this hearing. In fact, yesterday I was with the president in my district talking about housing and the importance of addressing housing affordability and lowering the cost, both for rent as well as the ability towards pursuing home ownership. So this is a very timely hearing. Dr. Lautz, is it? In the National Association of Realtors' most recent 2023 profile of home buyers and sellers, I noticed that there was an alarming increase in all cash buyers outbidding everyday folks who were barely able to scrape together a down payment. According to your more recent research, 32% of buyers purchased their homes in cash. Would you be able to provide any insights into the characteristics of these cash-rich purchasers, the kinds of homes that they're more likely to purchase, or the likelihood that they would even occupy their newly bought homes?
Yes, thank you so much. So in the last month, 32% of homebuyers did buy their home with cash. When we look at who these buyers are, what we can see is that among primary residence homebuyers, it's more than half of baby boomers who are making all cash purchases. So they've earned housing equity over time, and when they're able to make their next trade, they're able to do so with an all-cash purchase. We also know they're more likely to be long-distance primary residence movers, so perhaps moving to a more affordable area in the country, perhaps with migration flows because of remote work trends. When we look at other buyers, what we've seen in the last 6 months is more than half of vacation home buyers are paying all cash for their purchase, and a little over 40% of mom and pop investors, so we're not capturing institutional investors in that measure, they've worked with a realtor.
Why aren't institutional investors included?
Because it's based on a survey that we do on a monthly basis, based on our realtors' confidence.
Is it not available?
Correct, it's not
Right.
available.
Okay, that's the point I really wanted to get on the record. It's information that we do not know about these institutional investors. It's why I think it's important that HUD be able to collect the necessary data from the housing or on the housing market to get a more accurate picture. It's why I introduced last year a bipartisan and bicameral housing oversight and mitigating exploitation, or the HOME Act, to actually empower HUD to gather this data needed to understand the severity of our housing shortage and to protect everyday Nevadans from being exploited by potential market manipulators. Again, I just addressed this with the president yesterday. I was glad to see some of this included, but we need Congress to act. And to the chairman of this subcommittee, I would urge us to schedule a hearing on my bill, the Home Act, so that we can move that issue forward. I would also like to raise for the record an article from the Las Vegas Review-Journal. Most homes sold in Las Vegas are unaffordable. Without objection?
So ordered.
Ms. Bailey, as they've learned from the pilot on this issue, the Federal Home Loan Bank of San Francisco estimated that a race-neutral program targeted first-time homebuyers could reach more than 5 million households, nearly all of them Black or Hispanic. Would you please discuss the equity implications of even a race-blind down payment assistance program?
Yes. By targeting down payment assistance by first generation, we're able to bring resources to the communities that were locked out of historic homeownership opportunities and who still face barriers in the marketplace. A lack of down payment is the primary reason consumers of color report having an issue with entering into homeownership. So if we actually give them that fair opportunity through the use of first generation, again, we could grow homeownership for 5 million new home buyers. 1.7 million would be Black, 1.32 million Latino, and 1.4 million white. And these
And that would help close the racial wealth gap, because
Yes.
we would build equity, which helps build wealth for those individuals.
And give them an opportunity to compete against those institutional investors who are buying up all the affordable housing stock in their communities.
Would any of you like to discuss the growing incidence of rent-burdened household in this country with the remaining time left?
Just like to say that consumers of color are the most cost burdened, Latinos and African Americans especially, with rents. And again, institutional investors are playing a role there because they're buying up all of the affordable housing stock. So we need to make sure we are really supporting our Housing Choice Voucher Program so that we can make sure borrowers with the lowest incomes get the ability to safely and live in decent.
I appreciate the gentleman's time, and I would just urge us to not just talk about this issue, but to schedule bills so that we can act on it. With that, I yield back.
I thank the gentleman. I think we noticed 3 bills for this hearing. Happy to talk to you about your bill. The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much, Mr. Chair. I'd like to start by noting that the difference in home ownership rates between Black and white households is larger today than it was before the passage of the Fair Housing Act of 1968, when housing discrimination was legal. Let that just sink in. I know in Michigan we lost more Black homeownership during the foreclosure crisis than any state in the country. Nationwide, we know that white homeownership rate is about 74%, a 28 percentage points higher than Black homeownership rate. In my district alone, the gap is even wider. It's 81% from my white neighbors are homeowners, while only 47% of my Black neighbors own their homes. Even when comparing households, even when we compare households with similar education levels or incomes, home ownership gaps persist across racial groups. So Ms. Bailey, Vice President Bailey, what explains the fact that the Urban Institute reports, Black applicants with incomes above 150% of the area median income have a higher denial rate than white applicants with lower incomes between 50 to 80% AMI? Help me understand this.
Thank you so much for the question. I lifted up in my testimony the recent record settlements that the Department of Justice had. Discrimination is not a relic of the past. It remains a problem in our housing sector. And in fact, we know that white Americans with lower incomes actually have a higher homeownership rate than wealthier African Americans. This history of discrimination continues to manifest itself in our marketplace.
And it's really just shocking because many of these settlements are not really, it's almost Band-Aids, because for me and many of my colleagues, we talk about the Community Reinvestment Act, we talk about fair housing. We need to truly enforce them in a way that, again, pushes back against what we know is very much systemic racism within the banking industry. I see it with even small dollar mortgages. Many of my residents, want to be able to afford their homes that are less than $100,000. They can afford it, but they're not actually being approved for loans less than $100,000. Ms. Bailey, I've been trying to get HUD, and I've talked to Secretary Fudge about this over the years. This is so incredibly important. How can we get our banking institution, what can we do as a federal government to promote small dollar mortgages?
I think the GSEs could provide more liquidity for small dollar loans. I think that's a really important start. And the thing we want to really be careful with the lack of small dollar lending is that those consumers are then only left with exploitative credit options. Yeah. And we want to make sure that our nation's consumer protection laws are also fully enforced. So we need to enforce to the degree and well our nation's fair lending and housing laws, but we also need to make sure the Consumer Financial Protection Bureau can well enforce our nation's consumer protection laws.
I know 50 million, roughly 50 million consumers out there, Vice President Bailey, where disproportionately people of color lack the credit history necessary to produce a reliable credit score, not because of the different stereotypes that might go through people's heads, they don't have the same access. Historically, my Black neighbors have enjoyed less access to varied programs like FDIC-insured bank accounts and revolving credit that have allowed many of our white neighbors to build their credit profiles. Research actually has pointed to possibility of using other measures to assess credit worthiness. For example, cash flow and rental payment data can be used in mortgage underwriting, and both Fannie Mae and Freddie Mac have begun initiatives on that. Ms. Bailey, can you talk about the use of alternative types of data in mortgage underwriting and impact use likely have on our
Yes,
neighbors?
it actually works. Things like positive rental payment data is really most analogous to homeownership payments. And what we've seen is that the Black and Latino homeownership rate has been able to grow between 2019 and 2023 because we have been looking at these more inclusive methods of underwriting, comparing it to things that are most analogous to homeownership. And we have to remind ourselves that cash flow data is data that we always looked at historically, and we moved away from some of those traditional underwriting criteria with the things like desktop underwriting. So we need to go back to those traditional things that work.
Yeah, I mean, I know a home is often a family's most valuable asset, providing wealth that unlocks opportunities today and future generations. And, again, I think we really need to realize the crisis that we have, and so especially when we see these numbers again, that is larger than before the passage of the Fair Housing Act. With that, I yield.
I thank the gentlewoman. The gentlewoman from Texas, Ms. De La Cruz, is now recognized for 5 minutes.
Thank you, Mr. Chairman, for holding this meeting today, and thank you to the witnesses for appearing before us. I am glad to see our committee's continued focus on housing affordability and availability. As I've shared before, South Texans and Americans across the country understand the very real impacts and challenges of today's housing market. As homeowners and homebuyers continue to see decade-high interest rates and inflation impact nearly every area of their monthly budgets, it is clear that working class and middle class Americans face increasing challenges trying to achieve the American dream today. That being said, Dr. Lautz, this committee has also rightfully highlighted housing concerns for our veterans and disabled veterans recently. In your analysis, what are some of the unique challenges our veteran populations face in accessing affordable housing?
Absolutely. Thank you for the question. When we look at recent home buyers, what we have seen in the last year, repeat buyers are telling us 13% of them that when they took out a loan product, they did use a VA loan, and about 1 in 10 first-time home buyers are accessing that as well. It helps them in saving for a down payment, and what we see over time is that they successfully pay their loan, and they have the lowest default rates among all borrowers.
That's great information. Thank you for sharing that. To me, the American dream and home ownership, as I said, they go hand in hand, especially for our nation's veterans. I am proud to have introduced the bipartisan VA Home Loan Awareness Act for this reason. We can and should provide our heroes with the opportunity to achieve homeownership and the American dream they fought to protect. We also, unfortunately, know that some of our most vulnerable heroes, disabled veterans who have earned dignity and respect through their service, oftentimes need additional support. That is why I have introduced this bipartisan legislation. We must ensure that disabled veterans are treated consistently and fairly by HUD's housing support programs. And I look forward to continuing to work in a bipartisan manner to make this happen. Dr. Fratantoni, with that in mind, we see that the changing characteristics of the average home buyer indicate that working class and middle class home buyers face increasing challenges in today's market. Do you know off the top of your head, for a state like mine, Texas, what does the average home buyer look like today?
Yeah, that's a great question. So we know that Texas homebuyers rely on government housing programs like FHA and VA to a greater extent than borrowers across the country, with 31% using those FHA, VA, and RHS loans compared to 25% for the nation as a whole. Even with that, we know that the homeownership rate in Texas is about 2.5 percentage points below the national rate as of the fourth quarter. So Texas you often think of as a more affordable portion of the country compared to the coast, and yet many of your constituents, again, really struggling given the challenges. We know that it goes beyond housing, right? We're seeing delinquency rates on consumer debt increase for credit cards, for auto loans. A lot of households are stressed well before they get into the housing portion of their portfolio, right? And then right now, mortgage delinquency rates are extremely low, but I think with any softening in the job market, we're watching closely to see whether those delinquency rates might increase.
Thank you. I yield back.
Thank you, the gentlelady. I'd like to thank our witnesses for your testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for witnesses to the chairman, which will be forwarded to the witnesses for their responses. I ask our witnesses to please respond as promptly as possible, and this hearing is now adjourned.